So you've heard about investing and you have no clue where to get started. There's tens of apps, hundreds of stocks, and you're on a fork not knowing where to go. Here's a quick 20-minute guide that I wish I had when I started my investing journey, and it'll take you through the ins and outs of investing in just 6 simple sections. So let's get started. Hi guys, can't believe I've been procrastinating this for almost a month now.
Really, nigga?
But today we're shooting the how to invest in stocks guide for Canada, for US, wherever you're in the world. You can use this video to your advantage. The methods that you will be learning in this particular video are a low risk and consistent reward method. More or less, we're not trying to gamble our money. We're not trying to bet on the horse that's gonna, make you rich overnight. We're following a trusted process that will consistently reward you for being an investor in good businesses and at the same time help you minimize the risk. So let's get started. So in case you don't know me, I'm Rahul. I'm a marketer and a content creator from Toronto, Canada. I've been investing for the past 3 years. I'm not gonna say, oh, I'm some expert or I'm already a multi-millionaire, but this video is more or less to show you what really works for me, and hopefully it'll also help you do some great investing. So here's how this video is going to be. Number 1, we're going to cover some important rules of investing. Number 2, what are the different apps, the different accounts that you can use for your investing, basically the different instruments. Number 3, we're going to cover on what you should be buying as a beginner investor, as somebody who wants to go through the stock market without burning their feet. Then number 4, we will be covering how to actually make those investments, how much money you should put in, how much should you go all in, all those questions we're going to answer. And then number 5, we're going to see how to measure your personal results. And then the number 6 will be the final book recommendations, where you can go and further enhance your knowledge and get even better returns. You already know that stock market is a very risky place. I've been here for 3 years, and the amount of frauds, the amount of manipulation, the amount of pumping and dumping I have seen, I can't really trust anybody on the stock market, and that's what I advise you as well. The rule number 1 for investing is to minimize risk. Warren Buffett has 2 important rules of investing.
The first rule on investment is don't lose. And the second rule on investment is don't forget the first rule, and that's all the rules there are.
And that should be your most important principle when you're investing. Things like stocks, things like bonds, these are financial instruments, and these are manipulated by speculators, by opportunistic investors, by opportunistic capital to basically take advantage of less aware investors. It is very, very easy to lose your money.
I've fallen.
So if someone tips you something about a particular stock that, oh, this will be the next big thing, this company could be the next Tesla, this company could be the next Microsoft, your first step and your only step should be to listen to this information and disregard it without taking any action. Because our goal with investing is to build long-term wealth. Yes, there is a chance that you may find the next Google or the next Microsoft, but then there's also a 99% chance that you will end up with a dump stock that will actually make you lose your money, and losing money really, really hurts. Number 2, we're going to be practicing passive investing. When you're putting money, when you're buying stocks, there's 2 things that you can do. You can either buy and hold them for a very long time, which is investing, or number 2 would be trading, where you basically buy and hold a security for a very short time, sometimes for as less as a few hours, and then you sell it out for a very short-term profit. This has 3 typical disadvantages. One of them is it takes a lot of time to be a trader. If you're a full-time trader, this is more like a full-time job. You're coming every day, 8 a.m., you're starting to research the market. Then 9:30 a.m., the market opens, you're pretty much trading full day until 4 p.m. Short answer, you cannot do a full-time job if you want to be a full-time trader. The bigger disadvantage is that you pay a lot of trading fee. Even if you're using a commission-free app, you are paying a fee, whether that's upfront or it's a hidden fee. Sometimes traders can pay as much as 4 to 5% of their entire portfolio in a single year in just trading fee. So first of all, you need to cover that trading fee just to make any gain, and that just makes it extremely difficult to get better returns through trading rather than long-term investing. Trading is emotionally damaging. It takes a lot of pressure on your mind to every day try to find out and predict the short-term movement of a particular stock. Not everybody is ready for it, and not everybody needs to take so much emotional damage, especially when there are much easier ways to get even better results. And I would rather go on a path that is proven, that is simple, that lets me enjoy my life, rather than go on a path that takes time out of my relationship, takes my focus away from my job. I've seen so many people who are at their work, but they're opening their profile and checking their portfolio every 10 minutes. So if you've been doing this, you must absolutely part your ways from trading and go into the safe haven of long-term investing. So invest for the long run and live your life. And as Warren Buffett says, don't buy something that you can't hold for 10 years. Rule number 3, shop your stocks like you shop your grocery. The biggest reasons why investors don't actually realize the profits that they expect from their investments is not because because they buy wrong stocks. It's because they buy the stocks at a much higher price than they actually deserve. And the higher you pay, the lower your returns are going to be. So when you're in the stock market, you will hear all these crazy stories. Hey, like this is the new hot stock, this is going to be 10x, whatever, la la la. But when you actually look at these stocks, you're gonna see that they're already very, very overpriced for what revenues these businesses make. I'll just give you a very quick example. The stock of Block, which is Square previously, currently has a PE of somewhere around 190. So basically you're paying 190 times the price of the current earnings of the business. Somebody might say this is the next big fintech stock, this is the future of the fintech, but I would rather say that that growth that you actually expect is already priced into the current share price. So if an investor is buying this and he expects to make a 10x profit, his profits will actually be much more diminished because he's paying such a high price for that investment. And finally, the bonus rule. Big businesses like Amazon, like Google, like Microsoft, they take years and years to become profitable. So if you're buying a stock, please be planned to hold it for a very long time. Somebody's gonna ask me, what's a good time to hold a stock? I would say a minimum of 2 years should be your absolute mandatory. So you should do really good research and then you should buy the stock that you can hold for minimum of 2 years, maximum forever. So we come to the part number 2. Now the part number 2 is about the platforms and the different accounts that you can use for investing. So if you wanna buy stocks, if you wanna buy securities, investments, you need 2 important things. One, an app, whether that's on your phone or your computer, that helps you buy and sell the securities. Number 2, you need an account where you actually store these financial vehicles. In Canada and US, we have 2 types of accounts, your tax sheltered accounts and your non-tax sheltered accounts. Now for your tax sheltered accounts, you have multiple different options. In Canada, we have a TFSA account, an RRSP account, and in US, you have a 401k and a Roth IRA. Now these accounts pretty much help you avoid the taxes that are based on your capital gains. If you buy a stock today and it appreciates in $1,000 in value, but you hold it in your TFSA account, which is your tax-free savings account, you don't have to pay any taxes on the gains of this capital. These accounts can give you a very, very big advantage when you're building your portfolio to the first 100,000. So I highly recommend everybody signing up for these accounts. One thing to note is that these accounts actually have limitations of how much you can invest through these. In Canada, you typically get like a $6,000 yearly amount on your TFSA account, and your RRSP contribution is depending on how much income you make. Make sure you check those things and you don't over contribute because then you can get penalties. Highly recommend to first maximize these accounts and then go for the second type of accounts, which are the cash accounts or your non-tax sheltered accounts. Now these accounts work very similar to what a cash account or a checking account is. Let's say you make $1,000 of income by selling a stock. You're going to be paying your taxes based on your income level. In Canada, we typically pay 50% of your capital gains. So if you made $1,000 profit, you're going to be paying taxes on 50% of that, and then based on your income slab. So if your income slab is 30% and you made $1,000 profit, you're going to be paying 30% tax on 50% of your gain, which is 30% on 500, which is $150. I don't really recommend these accounts for everybody. Unless you have already maximized your tax-free savings accounts, then you must open a cash account and you can do investing there. I personally do use a cash account and I highly enjoy it. It still gives me much better results than keeping my money in cash and not investing. So I would still recommend you to get these only in the case you are already maximizing those tax-free accounts and you still have extra cash to invest. And now platforms. So in Canada, in US, in UK, in Australia, there's so many different companies, especially there's so many new fintech startups helping people buy more and more stocks. And I have a very mixed feeling when it comes down to different, new innovations in the financial space. First of all, there's apps that are called commission-free traders. Robinhood in United States, Wealthsimple in Canada. These apps promise to provide you free trading, but at the same time, they do actually charge you all those fees just through sneaky hidden methods. As an example, Wealthsimple in Canada does let you do trading for free, but it charges you a 1.5% currency conversion when you buy a US stock and 1.5% currency conversion when you sell a stock in US dollars. That basically eliminates 3% of your net capital invested, and that is a very sneaky way to earn money from a customer. On the other hand, a very popular app on United States called Robinhood actually charges for payment for order flow. So instead of charging you an upfront fee per trade, they basically say your trading is free, but when you actually buy a stock, they're gonna charge, a few cents on every single share. And let's say you're buying 2,000 shares of a very small company and you're paying, let's say, 3 cents or 2 cents on every single share you buy, you're gonna be paying them like $40 for that one trade. It's just that they make it very sneaky and they make you think you're smart and you're not paying any fee, but you are paying a fee just in a very hidden way. About Wealthsimple, my opinion is slowly changing because they recently introduced this new plan where you can, buy a $10 subscription monthly, and that lets you do multiple trades in US dollars. Again, I think they have a very long way to go and is just not a way I like to do business. I like people to be upfront. If you need $5 to do a trade for me, you need $5 to do a trade for me. Simple thing. You are a business. You have your cost. You have employees. You have overheads. Be fair and, charge whatever you need to rather than creatively manipulating my fee. There's also a second type of brokers, which are also known as low fee online brokers. Now, these are more typically your banks, your financial institutions, and these companies are more or less taking an upfront fee. So they might say, hey, I'm going to charge you $7.50 for a single trade, or like Questrade, which I personally use, charges $5 for a trade. These apps have their own advantage. First of all, they're much more fair. Second, they might also give you very big, powerful online tools that can help you doing research, including managing, all your portfolios, some extra tools so you can measure your performance. A second advantage these apps give you is that they normally don't charge you any fee for buying ETFs or exchange traded funds. Like I personally use Questrade and I buy a single ETF every single month and I don't pay a fee for buying it. I don't pay any currency conversion. So that keeps my trading cost literally zero and that helps me maximize my returns. Now we come to the point number 3, what to buy. Here's where things become really, really interesting. The stock market has a lot of stocks. If you just look at the NASDAQ and the New York Stock Exchange, they have a total of more than 6,100 listed companies. And for a beginner investor to find that next Microsoft or to find the next, Apple out of this 6,000 possible options, it seems easy, but it's actually a very, very, very difficult task. There's a popular proverb that in investing, your hindsight is always 20/20, but your foresight is legally blind. So sometimes you're going to look back and you're going to feel, oh, I should have bought Microsoft 30 years ago, or I should have bought Tesla 10 years ago. That would have been such a great investment, but that's just because it's easy to see things when they have already happened. What lies in the future is unknown completely. And today, betting on a few stocks might put you in a much more riskier situation of losing all your money rather than getting a consistent good gain. So what's the solution? Here I have a bunch of eggs. Now let's assume all these eggs are all the money you have in the world. Let's say in situation 1, you basically put all your money in a single stock, or let's say a single basket like this. Now something happens to that company and for some reason this basket drops. What's going to happen to your net worth? On the other hand, a situation number 2 where you're actually more reasonable and instead of betting all your capital in a single stock or putting all your eggs in a single basket, you're taking multiple different baskets, that is multiple different stocks, and you're putting an egg in each of them. Now what happens if one of these companies fails? Well, pretty much nothing, because you're invested over a multiple range of businesses. If one of them or even two of them actually fail, your portfolio won't be affected that badly, and this is known as diversification. And luckily you can invest in this by simply buying an ETF or an exchange traded fund, which basically takes the 500 best companies of the United States, including Apple, Tesla, Google, Microsoft, Chevron, Walmart, Costco, all of those big companies, combines them in a basket and you just buy that basket. Now one thing you should note is that the S&P 500 actually has been a great performer for the past 100 years. It has yielded more than an annual 10% gain for the past 3 decades. In fact, in 2020 and 2021, the stock market has returned more than 25% gain for investors, and that would have been a splendid investment with undoubtedly great returns. Now there's also 2 big cons with investing in stock market. One, you cannot brag. You can't go to the barbecue party and tell your friends, hey, I picked the next Tesla, or 20 years ago I picked the next Microsoft. So you lose your bragging rights. Number 2, you may not become overnight rich. By investing in the stock market, you are basically putting your funds into lots of different businesses, and even if one of those businesses becomes an overnight success, your money is still divided into 500 different businesses and you may not become overnight rich, which anyway should not be your goal. If you're investing for the long run, you should be aiming for a consistent and dependable return rather than becoming rich overnight. So what about individual stocks, and should you be actually paying any attention to them? As much as I don't recommend individual stocks for people who have less than 3 years of experience in the stock market, some investors and traders can in fact get a great return on their investment by carefully picking some good stocks and building a portfolio out of them. Now this subject I wouldn't like to cover in this particular video, but if you want me to make a specific video on telling the criteria of picking individual stocks, I can definitely do that. But here's a very, very quick summary that we can go through about picking individual stocks. Number 1, I would recommend you to only restrict yourself to good blue chip companies like Walmart, Costco. Number 2, I would also recommend you to make a well diversified portfolio which should have a minimum of 8 to 10 stocks and up to 30 stocks. I would also recommend you to hold this portfolio for a longer period of time. If your portfolio has a short-term downturn and you are confident on the companies, these are good stable businesses, you may want to hold it for a long term. Given the fact that you did proper research and due diligence, again, that piece I'm not covering in this video. Part 4, how much to invest. In most cases, I would recommend you to first do a personal basic cash flow analysis on your income, and that will help you understand how much of your salary or your income you can put every single month in something as risky as stocks. Here's a very basic guide. Take your monthly income. Let's say you make $2,000 a month. Remove all the fixed expenses. This includes your rent, your car, your insurance. Let's say that was $500. You're left with $1,500 now. Now reduce a budget for your variable expenses. This includes your Uber, your food, your grocery, your car fuel, all that stuff. Let's say that's another $500. So you're left with $1,000 a month. Now this amount is your free cash flow. Also remember, if you have some additional expenses like you want to travel, you are saving up for a marriage, make sure you allocate that budget also before you take this free cash flow figure out. Once you have this free cash flow figure, I would recommend you to start with only 10% of your free cash flow per month, and the rest you can just save up. Now, just like when you learn to drive, you first learn about your car, then you learn about the road, then you learn about the traffic signs, then you slowly start driving on, the residential streets, then you go on the highway. Similarly, when you're starting to invest, I would recommend you to go with a very, very small amount of capital. One, that gives you enough time to learn. Second, it helps you get familiar with the stock market. Look, stock market is a crazy place, right? You can have major losses in it for a very short period of time, and if you're a beginner, it's very easy to fall in for emotions and panic. So start with a low amount and build as you go. If you're enjoying the process, it never hurts to put a little bit more money the next month. Here's where something is very, very important. When you're investing, I would recommend you to designate a single date on every single month where you're going to be investing, and the rest of the month you're not going to be buying or selling anything. There's twofold advantage to this. One, it keeps you disciplined. So let's say you decided that I'm going to be spending $400 on a single ETF every single month. You're coming at the first of every month and you're investing into it. Number two, it helps you reduce the market volatility. Instead of buying a stock when it's high or buying a stock when it's low, you're following a really mechanical means that tells you when to buy. Over the year, let's say you made one purchase every single month. So over the year, you made 12 purchases. That's going to average out the price of that particular ETF for the whole year, or in fancier terms, it's going to help you dollar cost average. This is what we learned in this section. Number one, do a personal cash flow analysis on your income and understand how much of an income you can actually put in riskier assets and have a maximum of only 50% in things like stocks, ETFs, and the stock market. Number two, designate a date and make an investing plan for yourself. This keeps you disciplined and helps you reduce the market volatility. So we're at the fifth section and I'm already tired, but this is about how to measure your results. At the start of this video, we understood that businesses take time to yield results. So an investor does not need to look at his investments like a hawk looks at his food. You don't need to be hawkish about it. But every now and then, every 1 to 2 years, 3 years, you should be able to come back and take a hard look at the businesses and see how they're performing. First of all, never measure your performance on a weekly, monthly, or even quarterly basis. Only measure your financial performance over a period or a span of years. Typically, I would measure my personal performance in a 1 to 3 year period, and even if in that time, if the stock market went through a recession, let's say a lot of people were losing jobs, there was a big problem in the economics, that is a very unfit time to actually measure your performance. But if everything has been stable, the prices have been stable, the volatility is stable, inflation is not catching up very fast, you should be measuring your overall performance every 1 to 3 years. Something you may ask is, what's a good investment return? Like, what's a decent return on the stock market? And if I get that, I should say, okay, my portfolio is a success. Well, I would say if you're able to get anything more than 10% on an yearly annual gain by investing in a particular portfolio, whether that's made of a single ETF or multiple different blue chip stocks, you're good to go. Because even at the highest level right now in the United States, the inflation is close to 6.5%. If you're getting a 10% annual gain on your portfolio, you're beating inflation, your money is at work, plus you're getting a healthy 3 to 4% annual return. And if all that is happening in a tax-free savings account, so if you're doing that, you shouldn't be too concerned about your performance. If you're picking individual stocks, I would always recommend you to also compare it to the overall market average. And if you're underperforming the market, maybe you want to not pick individual stocks, you want to quit that game and just go on a simple track and just invest in the stock market through a basic ETF. Now, one thing I would also recommend is if you have saved up some money for, let's say, a future need that is very, very important in your life, like a medical expense, an education fee you have to pay, keep this money away from your stock portfolio. Stock market is still a risky place, and in history, there have been times when stock market would stay depressed for multiple years, and in this time, you don't want to have any important funds logged in the stock market, so only put which you can hold forever and without affecting your actual life. Finally, we're at section 6, and this is the books that you can read as an investor. I'll be recommending you 4 of my favorite books. Number 1 is The Little Book of Common Stock Investing. Now, this is a very simple beginner's book. It will help you understand all the basics of stock market, of investing, and help you understand more about ETFs. This was written by John C. Bogle, which is the founder of Vanguard Group. It tells you about stock market, the mechanics, the ETFs, how ETFs can benefit you, and overall help you build a very nice defensive investing plan. Number 2, The Psychology of Money. This is also a beginner-friendly book and more of a story book because it tells you small stories that help you understand finance and how the world of finance has been shaped. It will also help you understand how a beginner can really excel at the financial markets without even having a background in finance. So I highly recommend this book for everybody. Number 3, The Intelligent Investor. This is the Bible of investing and my favorite book in the world. I have personally read it more than 15 times and I still feel if I read it one more time, I'll learn something again. And I highly recommend every single person who's interested in investing for long term. The book was written by Benjamin Graham, teacher of Warren Buffett, and David Dodd. They're both excellent value investing teachers. In fact, Benjamin Graham is known as the father of value investing. And finally, number 4, Securities Analysis. There are very few books in the world that are just timeless. Whether you read them today or you read them 100 years from now, it will always help you become a better investor. Securities Analysis has very fundamental and technical processes that can help you find better securities. I don't recommend this book for everybody. This is a much advanced book. In fact, it's a very thick book to read. But if you have already finished The Intelligent Investor and the first 2 books and you have read a few more books and you're now interested in, picking your individual stocks, picking individual bonds, you want to be a much better professional investor, I would recommend you to read the Securities Analysis. So that's all, folks. If you have so far been watching this video, I highly thank you. This is one of my longest videos I have ever recorded. Please make sure you give me a like. If you want to catch up with me on Instagram, my username is in the description. And see you next time.
Really, nigga?